Welcome to Grow Your Business and Grow Your Wealth. Gary Helt is excited to bring you another powerful conversation to help you grow and protect your business and finances. Today's episode is hosted by a special guest, personally selected by Gary, so you can keep learning and moving forward even when Gary is off the mic. Settle in and enjoy today's insights.
Welcome to Grow Your Business and Grow Your Wealth. I'm your guest host, Ken May, tax planning specialist with BA Services, Overland IQ, where we go above compliance and beyond expectations to help clients make smart, proactive financial decisions. Today, I'm joined by Sam Young, owner of Overland IQ, a trusted partner to business owners and professionals who are real estate investors who want to increase cash flow, reduce risk, and build long-term wealth strategically. Sam Young is the owner of Overland IQ, where Sam works closely with investors on tax optimization, cost segregation, insurance efficiency, ownership structure, and CFO-level financial strategy. You can review Sam's business at overlandiq.com, email Sam at sam@overlineiq.com, or call him at area code 401-339-7930. Sam, let's start here. What originally drew you into the real estate financial optimization?
Yeah, absolutely. Hey, Ken, great to be here. So I started my journey in kind of real estate or generally tax advisory, really from my first ever job out of college. I was in finance. I was getting into private equity. We were doing land acquisitions, property acquisitions throughout the nation. We were buying different, residential properties, single family homes, multifamilies, as well as some simple commercial self-storage, strip malls, etc. So I was running those deals. Right now I would say probably totaling 1.5 billion plus in total values, and have seen a ton of deals. And I was the one kind of closing those deals. So I got exposure to how to structure those things and the suite of tax optimizations and financial optimizations that larger private equity or larger organization do on a kind of per deal or daily basis. So that's how I got in, and later on decided to start my own business to make the tools previously only available to the big guys available to everyone else.
What patterns did you begin noticing across investor portfolios?
Yeah, so patterns, there are different ways to talk about that patterns. There's investment patterns, that shifts from year to year, like, the single family home or multifamily home coming back in certain regions. Commercial offices, took a hit a couple of years ago and are now, in okay stage, depending on their class and the metropolitan regions. So for today, I guess we're talking less on the actual deal dynamics patterns, but more on the maybe, for today's purpose, tax patterns. So that really is kind of related to the recent legislative changes introduced by the Trump administration. So last year, Trump brought back one big, beautiful bill, which permanently re-enabled the 100% bonus depreciations. So that's a huge win for property owners and property developers. And I'm seeing increasing tax optimization strategy as one of the major, if not the only motive of a lot of acquisitions lately.
How has working across multiple properties shaped your approach?
Yeah, so you start to see very universal, kind of consistent patterns, regardless what type of property types you deal with. I think there's generally two worlds between, if you're buying it as residential for residential purpose, for your own personal purpose, that's a totally different story. The tax treatment is different. As long as you use it for commercial, like to make money out of it, either to rent it out as residential apartments or as commercial short-term rentals, or actually for commercial usage, that pattern is very consistent. The tax treatment is very, very similar. And we're seeing a ton of people reaping the kind of tax benefits from those deals.
And in your experience, what separates sophisticated investors from reactive ones?
Yeah, so the sophisticated investors really plan ahead. They see 5 steps into the process before even starting, making a bid on the property. That includes, obviously the purchase price is a huge thing, but how to structure the deal. What do you negotiate on in terms of purchase agreements? There's other, entity structuring, tax structuring, liability structuring or shield that you have to put in place even before making that acquisition, even before putting in a bid. So that really, what I see sets apart a sophisticated investor versus some of the investors might be just starting out.
Let's talk about hidden cash flow. Where do most real estate investors quietly lose money?
Yeah, so if you look at the P&L of any property owners, the number one thing is obviously property management, the maintenance costs, etc. There's a lot of there's a lot of opportunity to work with individual high quality contractors directly to save money on that property management cost. So that's one of the bigger areas. The second and third are more hidden. I would say those are where most of the common investors lose money on. That is tax and insurance. So on the tax piece is interesting because, I mentioned earlier, there's a one big beautiful bill that came out last year. So that basically introduces the concept of cost segregation or the tax benefit from cost segregation for properties. Without getting into too much detail, basically, if you buy a property for, commercial use, for, renting it out, you can deduct depreciation against your income. And there are a couple of ways to think about it. So usually what people do is when they buy a house, the property, the actual building value itself is depreciated over either 29 years or 37 and a half years, depending on how it's treated. Is it for residential usage or is it for commercial usage? But you can break out certain percentage of that house to say, hey, not every component of this house is concrete or the ground. Many of those things like carpet or millwork or cabinet, those are actually personal properties. Those are not constructions. So if it's something falls under personal properties, they can depreciate much, much faster, which means, once the one big beautiful bill is back, actually the tax treatment now allows you to just write them off in day one. So think about a $1 million property, $1 million kind of property value, the building value itself, because land is not depreciable. Uh, you know, Depreciating it over more than 20 years versus writing it off right away upfront. That makes a huge tax difference.
How do taxes, insurance, and ownership structure interact financially?
Sorry, can you ask me the question again?
How do taxes, insurance, and ownership structure interact financially?
Yeah, that's a really good question because um, so when you're talking about, let's say, a residential rental, which depreciates over 27 and a half years, non-residential depreciates over 39 years, um, and say you write off 30% of it because you utilize the bonus depreciation. Now you've got, let's say, $300,000 in depreciation expense to deduct against your income. If not structured properly, you can only use that 300,000 to deduct your rental income within the house or any other passive income, which means that, not everyone, like if you're a W-2 employee, it's not going to save you that much money because you don't have enough income to deduct against because your W-2 It's a different bucket than say your residential, non-residential bonus depreciations. But with proper structuring, let's say you use it for uh, Airbnb and you materially participate in that operation and you fulfill the kind of 100-hour minimum needs, hour spent on this property management needs, that allows you to quote unquote activate that passive real estate depreciation, massive write-off of 300,000 against your other active income. Say if you're a doctor or you make W-2 salary, um, we can, you make 300K on the other side, then it completely offsets so you don't pay any tax.
How often should investors revisit optimization on an existing portfolio?
Yeah, so you really should do that at every when you purchase every property for rental or personal, just even for personal rental, per personal living quarter as well. So at each deal, and also definitely on an annual portfolio review basis. What like you should always go through with your tax planner, CPAs on, what building has depreciation already deducted, how much left, what's your cash flow look like for the next couple of years, what's your personal income profile like for the next couple of years to make sure, income and expense are well planned, timed, so you pay the minimum tax.
Cost segregation gets talked about frequently. Can you explain it clearly and simply for our audience?
Yeah, so cost segregation, again, I explained it earlier. It's accelerate a portion of your house overall value, break them down into, the structural, kind of the actual, the building part, and the personal property part, which you can't write off completely after the one big beautiful bill. And yeah, it's all about kind of classifying expense and cost basis into different buckets. Usually, the rule of thumb, it's anywhere from 25 to 35% of the building cost is considered personal property, and it's a direct write-off as a result. But you do
Types
need the very comprehensive analysis done, usually a 60 to 80-page reports to validate that claim. That's why there are many. It's very important to get a legitimate kind of cost segregation company to do an analysis so you can deduct that bonus depreciation.
What types of property benefit most from accelerated depreciation?
Any property really, any property that you're using to rent out for kind of for commercial usage or for renting as residential apartments, etc. They all share very relatively similar kind of ranges in terms of how much you can write off as personal assets. It does vary, like a very highly decorated uh high-end condo is going to be different than say a self-storage unit in terms of the percentage of the building value you can write off. But more or less, it's you can benefit from cost segregations for any type of properties.
Why do many investors complete one study and never revisit it? And how do renovations create additional deduction opportunities?
Yeah, so cost segregations, you set it up once per property and you don't really change your depreciation schedule for the years to come. It's established. So technically you can only do one cost segregation per property. But the revisiting on an annual basis is more for personal tax planning, how that depreciation lines up with your personal timing. That's a separate thing. Uh, in terms of sorry, what's your second part of the question?
How do renovations create
Oh, how
additional
renovations?
deduction
Yes.
opportunities?
So renovations are considered capital improvements usually, and usually you need to kind of depreciate over years if it's a kind of any major renovations. However, similar to buying a new house or a new business property, certain part of that renovation is considered personal property as well. Like for example, uh, putting up a concrete structural pillar that's obviously part of the building, which should be depreciating for much longer terms. But redoing your carpet or buying kind of cabinets, building cabinets, etc., that might be personal properties that you can just write off. So cost segregation principles apply uh, similarly to renovations as well.
Can you explain partial asset disposition and why it's often missed?
Yes. So when you do a renovation, there's two sides, there's two tax benefits. First, you are disposing of something of value, if it's still functional, if it's not like totally valueless, you can write off whatever you replaced, the original item that you're trying to replace. For example, a roof. Uh, like if the roof still has some, life left, or like a HVAC unit, there's some value to it. And that depends on the basis is established by the original cost segregation, so analysis. So when we provide a cost segregation report, we give you a detailed breakdown of, hey, what's the value for each component? What's the roof's value? What's your HVAC's value? And 5 years later, maybe the roof depreciated for another 5 over 27 and a half, or 5 over 39 years of that amount. But it still has a remaining basis. When you dispose of it, you get to write it off as a loss from your personal tax income. So that's partial asset disposition. And many CPAs, many people actually don't realize you can't do that, or they forget about it, and leaving kind of tax savings on the table.
Traditional engineering studies can be expensive. You develop studies under $5,000. How have you made that sustainable while maintaining quality?
Yeah, that's a really good question. I think a lot of the cost segregations, it's documentations. It's documentations and applying engineered applying very extensive IRS rulings to those numbers. So we use a mix of automations, in Excel or in data collection process, that get to accelerate our kind of groundwork to set up the study. But we apply the same level rigor, same level of rigorousness of engineered based analysis to those numbers to get to the right ranges for the IRS for you to use that the bonus depreciation. So to summarize it, we try to automate as much as possible on the data collection, data processing, data entry, but leaving the core engineering work to our a team of experienced professionals to focus on cost segregations.
Where are the efficiency coming from? Technology, process refinement, or scale?
It's all of the above. We have quite a bit of scale in terms of the different types, number of different types of studies we do. We definitely have a more streamlined process, much a leaner, more efficient team than some of the larger, more established players, and more use of technology automations in data entry and data collection.
How do you ensure IRS audit defensibility at that price point?
Yeah, it's really the same analysis that we do, similar to what other folks do at much larger firm, even some of them, like multi-billion-dollar accounting firms. It's the same IRS principle. We check against the same database we use. Like all of our engineers worked at those massive firms before and are familiar with the best-in-class quality of the cost segregation report. So that's exactly the same kind of level of quality we bring to those studies. There's very well established principles on how you should do a cost segregation study, what kind of documentation you need, what pictures you need, what type of inspection you need to make it legit and defensible. And we stick to all of the best practices there.
So if a client gets audited, do you have people that go with the client to the audit, or do you represent them yourself?
Yeah, we provide audit defense. We reply back to the IRS on your behalf. Our team, this is a lifetime guarantee of IRS audit defense that we provide. We have never been, all of our studies have never been audited in our firm's history. We do have practitioners, who have been in the industry 10 plus years, whose studies have been audited by the IRS when they were with the other firms. But none of them have anything have the IRS update or bring down the bonus depreciations they were allowed to deduct. So I would say that's a win.
What documentation do clients receive to protect themselves?
It's a 80-page report, 80 to 100-page report that detailed the engineering process, the cost basis, the methodologies we use, the court cases that we referenced. It's a comprehensive set of kind of documented supports that IRS asks for that we provide.
And when would you still recommend a traditional full engineering study?
Sorry, what?
Whoops, I got to back up. When would you still recommend a traditional full engineering study?
Yeah, that's a great question. We are a traditional full engineering study, by all means. But if you're dealing with like 100 million plus hotel, or like hotels or like massive sort of building compounds, like maybe some of the other firms might have more like 10 people on the team that can help you and do that study much more quickly. We're much smaller in that sense, but we have dealt anywhere from 200K single family house purchase, apartment purchase to 50 million apartment multifamily projects. So it really depends on the scale, but by all means, we are a traditional engineering based cost segregation firm.
What should investors look for to confirm a study was done properly?
It really comes down to the documentations and the study process. What did the firm document? What kind of questions they asked? If they gave you the right answers to some of the basic cost segregation questions. I think that's the most important piece. It's really kind of the level of thoughtfulness the firm brings to the study, and not overpromise on the results, right? One of the biggest red flags is tying their fees to how much tax savings they will provide. First is illegal. Second is just shows kind of the lack of thoughtfulness there.
Let's shift to insurance. You've mentioned insurance drift. What is it and how does it impact portfolio performance?
Yes, so insurance, because we are providing the cost segregation analysis, we document the property conditions, all the components, the age of each, appliances or the roof of the house. So when it comes to insurance, we can represent you and help you get a better insurance quote simply because we collected more data that we can help almost pitch your property to the insurance companies. That's how we save investors insurance money. And when it comes to actual insurance claim process, because we have the documentation, we have pictures, etc., of every single corner equipment inside the house, we're at a much better position to help you recoup as much loss as possible from the insurance companies due to the better documentations.
How often should insurance policies be reviewed strategically?
Sorry, what?
How often should insurance policies be reviewed strategically?
Insurance policy review strategically, I would say Um, it's a great question. I would say it comes down to insurance coverages. Like the many insurance, like say those coverages in very different languages, but you really need to have a professional to take a look at your insurance current policies to make sure it's covering all the unexpected scenarios that can play out. You know, we have technology, we have people, we have experts who can help you with those as well. We usually include it as part of our kind of cost segregation property review. We'll we'll review your we'll have relevant partners review your insurance as well to make sure you're fully covered. That's the most strategic thing, which is really downside protections.
What are the most common landlord insurance mistakes?
It really depends on state and locations. There's no one size fits all. We do have the best database, best providers, best carriers for each region that we're familiar with.
How does insurance strategy affect long-term ROI?
Um, so insurance is one of the top three costs that happen on an annual basis. So it's one of those things, you know, if you can save on insurance, it really help. It's a meaningful savings for a property owner. And over the years that you of your ownership, it really starts to add up and playing out in that ROI.
How exposed are most investors legally without proper structuring?
Sorry, what?
How exposed are most investors legally without proper structuring?
That's a great question. So most people are not protected at all, meaning that they might use their personal name or like a personal LLC as an owner for the property they want to rent out. Most of if it's just a single layer LLC, it's pretty easy to look up your personal identifying information online so people can still see who owns this property and can come to you, can come after you personally. So many sophisticated investors, they have different structures set up um, to hide their identity, to kind of limit their individual holdings liability to just that one building. So it's a mix of use of trust, LLC. And so there's a kind of a complex legal structure that we have worked with that I can recommend in more detail at another episode.
When should properties move out of personal ownership?
Sorry, what?
When should properties move out of personal ownership?
Uh, Yeah, so pretty much every property that you have any commercial income from and that you're, you know, having a liability exposure should be out out of your kind of personal ownership, or at least hiding from personal ownership so that you know you just minimize the risk. But you know, if you only have one or two smaller value, like lower value properties, then it probably is not a too big of a risk, too big of a difference. But anything, any serious serial kind of real estate investors should really try to protect with proper legal structuring.
How do entity structures isolate risk between properties?
Because you want to structure the LLC or trust so that if you get sued on one property for like $10 million, the property, let's say, God forbid, has to be sold or go down. The liability doesn't accumulate to yourself personally and doesn't impact your other portfolios.
And how do you balance protection with operational simplicity?
Yeah, so that's a great question. You know, again, at a smaller scale, lower value properties, it probably doesn't make sense. But for any kind of serious investors, the added operational complexity, which by the way, you can automate with the technology and tracking, just or better, just management system, and the benefits from better protection is more than worth it.
You approach this from a CFO mindset. How do you define the CFO role for the real estate investors?
Yeah, so it's the CFO is different from like a bookkeeper because we don't just record transactions, we help you plan out and forward looking, plan out and help you forward look and prepare for what's unexpected. We look at the situation holistically rather than just passively recording the transactions. So all these things that people might not think about, like cost segregation, like tax, like insurance, like uh, property management, liability structuring. We help you think through. So before you putting in that bid or a an offer, we help you think 5, 6 steps ahead.
What KPIs should serious investors track regularly?
Say cash yield and IRR and money on money multiples. Oftentimes it's about how much cash, or at least break even, if not positive cash flow from a property, and banking on the long-term appreciation of the property, which juices up your IRR or money on money multiple. So both short-term kind of cash flow and long-term total returns.
How do you forecast cash flow instead of reacting to it?
Um, you plan out all the tax scenarios, all the expense, plan out all the inflations, plan out maintenance, reserves, all that stuff. Like think through everything before you buy the property. And that comes from years of experience and thousands of deals we have seen and worked on.
What capital structure mistakes do you see repeatedly?
Over leverage, especially if the interest rate is adjustable at a certain point, being over levered really kills your cash flow. It's unexpectedly, especially as under reserved maintenance cost or once in a while kind of major capital improvement needs like replacing the roof. Being over levered really leaves you very little kind of wiggle room to handle those unexpected. But those unexpected will happen at some point.
When should an investor seek CFO level advisory support?
When an investor wants to seriously think about growth, expansions, that's when, merely recording transactions is no longer enough for someone.
How is technology and AI changing financial optimization?
It really helps with the data entry and data recording process. Many of the manual kind of repetitive work can be automated by AI, but still that also makes the judgment, the analysis work that much more important and precious when the rest of the like kind of manual work is automated.
What fintech trends should investors pay attention to?
Yeah, definitely AI in this LLM, different, cloud can connect to QuickBooks now, can run the analysis, definitely people should try it out. But by the end of the day, it's bad data in, bad data out. So really got to make sure your books are clean, all the transactions are in, properly categorized, having a professional look at and audit it. Yeah, and working with someone, not on just transactions, but kind of coming up with analysis.
Where do you see real estate advisory evolving over the next decade?
It's gonna be more towards proactive cash planning and again planning ahead 5, 6, 7 steps ahead versus just kind of advising people on purely educational content or reactive stuff because that part is going to be much more automated by AI or AI can answer really well.
If someone listening suspects inefficiency in their portfolio, what is the first step?
Sorry, what?
If someone listening suspects inefficiencies in their portfolio, what's the first step to correct this?
Um, Yeah, it's really kind of coming down to audit your P&Ls, like see how much money you're making and how like coming up with a plan budget, see if you can track against consistently hit your budget or stay within your budget and plan for the unexpected. So that's the first thing I would catch. The second thing is, if you're hit with the unexpected tax bills or insurance bills, that's where I think a lot of the red flags will raise as well. Last thing is, definitely talk to a professional on potential tax savings, insurance savings, all the things that maybe you haven't thought about.
What mindset shift helps investors grow wealth consistently?
Um, It's the number-driven approach. Every decision is not an emotional one. There's real numbers backed behind it, and that numbers comes from different sources, not just the what's on the surface, but what's behind the scene. Tax as a huge kind of return multiplier wasn't a big thing a few years ago because of policy. Now it is a big thing, also because of policies, and just being able to track those things and being on top of it is critical.
And a final question. What does growing your business and growing your wealth mean to you personally?
Yeah, it means sustainability and a balance. Obviously everyone wants to grow wealth, grow business. How do you balance it with personal, family? How do you do it sustainably with all the downside protected and all the tax and liability exposure optimized? Is critical to me. I want to grow. I want to grow wealth. I want to grow my business, but I also want to grow it sustainably, knowing that all my bases are covered and optimized.
To our listeners, if you suspect there may be hidden inefficiencies in your real estate portfolio, it may be worth having a strategic review. Sam, thanks so much for you sharing your insights and expertise today. It's been a real pleasure. To our listeners, if you'd like to learn more about Sam, visit his website at www.overlineiq.com or reach out to him directly by email at samoverlineiq.com or call him at 401-339-7930. I'm Ken May, your guest host for BA Services Inc. and Overline IQ, reminding you to keep planning smarter, stay proactive, and as always, keep growing your business and your wealth.